Welcome to Accounting 101. Today, I would like us to do this exercise of Statement of Comprehensive Income, where we will be preparing an income statement for Remic Traders. Remic Traders is an organization or an entity that is owned by a one person, on which we refer to as a sole trader if we look at the different forms of ownership. Then, whenever you prepare your statement of comprehensive income, or rather your income statement to be more precise, you are always given a pre-adjustment trial balance and you are given adjustments. Then you prepare your income statement using these two. Whenever again you prepare an income statement, you need to check whether you are using a periodic inventory system or a perpetual inventory system. With perpetual inventory system, it's also called continuous inventory system. With continuous inventory system, it is easy to identify simply because your cost of sales are given as an amount. But if you are using a periodic inventory system, you will need to calculate your cost of sales. Now, just to recap a bit, the cost of sales, if you are using a periodic inventory system, you will need to calculate them, and the formula is as follows: opening balance plus purchases plus carriages on purchases minus your returns plus your import duties minus your closing stock. That is how you get your cost of sales if you are using a periodic inventory systems. Then here on this exercise, it's easy to identify that we are using a continuous or a perpetual inventory system simply because cost of sales are given in the pre-adjustment trial balance. So the first thing that you need to identify if you are preparing an income statement is the financial year end or a timeline. By timeline, I'm referring to the beginning of the financial year and the end of the financial year. For Remic traders, the beginning of the financial year is the 1st of March 2014. Then the last day of the financial year is 28th February 2015. So, whatever that you're going to prepare moving forward, it must be guided by the beginning of the financial year and the end of financial year. If we are having a transaction that will occur or that will occur beyond these parameters, the beginning of the financial year and the end of the financial year, we won't record that transaction because it doesn't fall in or between this financial year. Then let us start with the trading account part. By the trading account part, I'm referring to sales less cost of sales, then you get your gross profit. The first part of your income statement, where we look at revenue collected or generated through selling of goods or rendering of services, less cost of sales. So we are applying what we refer to in terms of GAAP or GAAP concept, a matching concept, where we match revenue generated versus the cost that we had to incur when we are implying or when we wanted to generate what this revenue. So we are applying here what we refer to as a matching concept. So for Remic traders, we were given sales of 694,000 rands. Then on the pre-adjustment trial balance, we were given debtors allowances of 7,400 rand. Debtors allowances, they are also called sales returns. Now, customers returned back goods that were sold at 7,400 rand. Now, these goods that were returned back, it means us as a business what we need to do, because whenever we are recording sales, we record using two accounting bases of recording. We record using cash basis and we record using accrual basis. With cash basis, we record only cash transactions. But with accrual basis, we record when a transaction has occurred, even if cash is not received or paid. So here for sales, we are looking at 694,000 rands. That includes your cash sales and your credit sales. That includes your cash basis and your accrual basis. So minus 7,400 rand of your debtors allowances, goods that were sold for 7,400 rand. We need to say minus because these goods were returned back during the year. It means if we do not remove this 7.4 or this 7,400 rand, it means our sales amount is overstated. But now, if we say minus 7,400 rand, it means that we are acknowledging that there were goods that were returned back by customers because they were not satisfied. So our sales amount needs to be recalculated to 686,600. That is the correct amount or precise amount for your sales. Sales or revenue amounts to 686,600. Then less cost of sales. Cost of sales, we are looking at goods that were sold, but we are recording them at a cost price. We are saying to ourselves, this trading stock or this inventory is no longer with us, so we are derecognizing or we are acknowledging that these goods are no longer in our system. So we are crediting inventory and assets and debiting an expense, which is cost of sales, for an amount of 311,000. Then 686,600 less 311,000, you get a gross profit of 375,600. Now, we call this amount gross profit simply because it is a profit before we take into account other incomes, before we take into account other operating expenses. So this is a profit when we were looking at what are we selling as a business versus the cost of selling those goods. Then we are now getting a gross profit of 375,600. So we are done with the part of the trading account. Now let us look at other incomes. So you will see here there's a difference. We are no longer calling them revenue or sales, but we are calling them other incomes. So previously, when we are looking at sales, we were looking at revenue collected during the particular financial year, when we're looking at what does this particular company exist to do. This particular company exists to sell goods. Then we are looking at that income, because if we are looking at revenue, you are looking at International Accounting Standard 8. Then you are looking at revenue collected or income collected through the normal operations of the business. Now let us look at other incomes. We are going to add other incomes simply because they have what we refer to as a positive effect towards your gross profit. So we are looking at other incomes that this particular company is generating other than the selling of goods or rendering of services. The first income is your rent income. And rent income, we have an adjustment but we are also having a total. Remember, if we are looking at your expenses and incomes, we are referring to totals. But once you start talking about your assets, liabilities, and equity, you are referring to balances. So the total for rent income is 22,600 as per the adjustment, as per the trial balance. Sorry. Then we are having what? An adjustment where it says Miss Mills, a tenant, has occupied part of the building since 1 May. So let us go back to our timeline. We said the beginning of the financial year is 1 March 2014 and the end of the financial year is 28 February 2015. Okay, so during the year, we had this tenant that was occupying this part of the building and was paying 2,000 rand per month. Her rental was increased by 5% on October 2014. Adjust rent accordingly. Okay, let us go back a bit. The first thing that you need to understand here is that this particular tenant did not occupy this building for the whole year or for 12 months. This particular tenant, she occupied the building as from May to the last day of our financial year. So if we can count, it's May, June, July, August, September, October, November, December, January, February, of which it's 9 months. If it's 9 months, it means that we need to calculate what? We need to calculate the issue of an increase. So if she was paying 2,000 rand, the increase is 5%. Let us look at my solution down there or my calculations. We say 2,000 rand times 9 months as per the trial balance. Then we broke it down for us to be able to calculate this amount correctly. We need to separate it into the months that they were before or the months that were calculated before an increase and months that we need to calculate after or after taking into account what an increase. Then we have 5 months before taking into account an increase, which will give us 10,000 rand. Then here we also have what? For another 5 months when it is 2,100 now. You say 2,000 plus 5% or times 5%, then you get an increase of 100 rand. So it's 2,000 plus 100 rand, the increase of 5%. Then you get 2,100 times 5 months, you get 10,500. So here you'd say 10,000 rands plus 10,500 rands, you get what? 20,500. The amount that, if we include the first months before increase and months after an increase. Then, if we continue, we get what? We say 21,000 rands minus 20,500. That means this particular tenant is owing us or was supposed to pay 20,500 for this financial year. But this particular tenant even paid for how many months? For even for March the following year. of which that particular 2,100 rand, we will need to reduce or remove it from the rent income simply because it doesn't belong to this financial year. That is why we are removing is 2,100 rand. This particular amount of money, we call it an income received in advance. If we are referring to an income received in advance, we are referring to an income that we have received, but we are still to earn it. We call it an income received in advance simply because it is with us or it is in our bank account, but we are not entitled to it. The tenant is entitled to this amount as it can be given back at any time before March. So we are going to record it, remove it here in your income statement, income received in advance, and record it where in your statement of financial position, where we record it as a current liability, income received in advance. Then the second adjustment is in relation to a bad debt recovered. A bad debt recovered, remember, it starts from your debtors control or your account receivable, where we sell goods to our customers on credit. Then what happens is that these particular debtors will fail to pay as per the agreement that we had at an initial date of this particular transaction. Then it will result in a situation where we are forced as a company or compelled to do what? To write them off. When we are writing them off, we are reducing an asset and increasing a liability. A journal entry for that will be debit bad debts and credit debtors control. So these debtors, they are now called bad debts, no longer debtors, simply because they are no longer part of your debtors control. As an entity, we no longer expect to receive any form of money from them simply because we've written them off using an expense account called bad debt. So, surprisingly, these debtors, in rare circumstances, they tend to pay the amount. So, when they are paying this particular amount, debtors control is no longer affected simply because they were written off. So, now a new account is created, which is called bad debt recovered, which is an income reducing an expense for bad debts. Now, let us go to the adjustment number 2. An amount of 280 was collected from a debtor whose account had previously been written off. So we are recording 280 as an income that will reduce or that will permanently remove what? Your bad debt. So 208. Then you are done with that transaction. Next transaction or next adjustment is in relation to your provision for bad debt. Provision for bad debt is an amount or it's a liability of uncertain amount or timing. So this particular provision for bad debt, we set an amount aside as a business to cater or to make sure that we cover for a shortfall for debtors that will fail to pay as per our agreement. So to make sure that we are not suffering a huge loss, but this loss is compensated by this fund called provision for bad debts. Then here they are saying adjust. If they are saying adjust, not saying create, it means the provision fund for this bad debt does exist. So now you are adjusting as per their estimates, looking at the trend with regards to how are these debtors paying us. So they are saying adjust provision for bad debts to 5%, not by, but to 5%. Then in your trial balance, you are given an amount for debtors control or your account receivable. Then you minus or you say less bad debt as per the adjustment, not bad debt as per the trial balance. Because bad debt as per the trial balance, they no longer form part of your debtors control balance. But the adjusted amount or the amount of bad debt in your adjustment is not updated with regards to your debtors control. So you only need to remove that one because you are adjusting your pre-adjustment trial balance. Then you get an amount 33,230 debtors control net of bad debt as per the adjustment. Then you calculate 5% of 33,230 times 5%, you get 1,662. So they are telling you to adjust to 1,662. But if you go to your trial balance, you will see on the balance sheet section, you will have your 1,750 for provision for bad debts as a liability. So you are adjusting 1,750, reducing it to 1,662. Then that means we need to do what? We need to reduce the amount that have been set aside. We do not need in this case to do what? To set aside more, but we need to reduce what was set aside previously. And whenever we are doing that, it's an income because it's money back to the business, of which we call a provision for bad debt, which is an income in this case. Then we go to your interest on fixed deposit. Interest on fixed deposit, we are having 3,990 as per what? As per your trial balance. Then what we need to do there, we need to go to the trial balance again and check on the investment, this fixed deposit. And this fixed deposit is at 12%. So what we need to do here, this fixed deposit is at 12% and the initial amount is 79,000 rand before interest, multiply by what? Multiply by 12%. Then we get an amount of 9,360 rand. That means this is what we need to receive. 9,000, sorry, 9,360. But we have received only 3,990, which means the difference between the two is 5,370. This 5,370 is not received as yet, but will be received, or we're supposed to have received this particular amount of money. Therefore, what will happen, we will add this amount because it belongs to this financial year that is ending on 28 February 2015. Therefore, we are saying to ourselves, this is what we are supposed to receive. Remember, when you are preparing an income statement, you use both accounting basis for recording. You use cash basis and we use accrual basis. So 3,990 is what we have received. It's your cash basis. But 5,370 is your accrual basis, what we expect to receive. And we are going to add this amount, 5,370, then also record it in your statement of financial position as what? As accrued income or income receivables under your current assets. Then the amount of discount received is given as it is, and there are no adjustment with regards to it. So the amount will be 400 Rand. Then we will add all incomes, then we will get a total amount of incomes, which is 30,628, which will have a positive effect to your 375,600 of your gross profits. Now let us continue. So you are having a gross income that is a total of your gross profit plus your total for other incomes, that where you will get 406,228. Then less operating expenditures or operating expenses. Now we are taking into account that we also incurred expenses during this financial period that we also need to take into account, minus it from the gross income, then get what we refer to as net income or net profit. That net profit will be given to the owner of the business. If we are doing an income statement or statement of comprehensive income for a company, it was going to be a net profit distributable to the shareholders. But in this case, it's a one-man owned business, a sole trader. Therefore, this net profit belongs to the owner, and the net loss is suffered by the owner. So the first entry that we made here is trading stock deficit. Your trading stock deficit, and the adjustment is according to a physical stock count. The following stock was on hand on 28 February 2015, which is 56,000 rands. Then, according to the trial balance, you had 56,200. So the amount that was found through the stock count exercise is 56,000. It's less than the amount as per the trial balance. So we will need to reduce the amount as per the trial balance to the most reliable figure or amount, which is 56,000 Rand discovered through the stock count. Therefore, what we need to do here, we are reducing the balance as per the trial balance, as per the pre-adjustment trial balance, which will give us an amount of 200 Rand, which is unaccounted for, and further investigation will proceed. Then the second entry will be your stationery. Your stationery, we are referring to items that are consumables, items that are needed for administration of a particular business. And your stationery amount, as per the stock count, also revealed that we are having stationery valued at 180. Then, as per the trial balance, we are having stationery valued at 2,408. Then, the difference here is this: whenever we are buying stationery during the financial year, we treat it as an expense. Then, at the end of the financial year, stationery on hand or unused stationery, we regard this as an asset because there is still a value attached to this particular stationery. Then we reduce it, we say minus 180, simply because this one will also be carried forward to the next financial year. Therefore, it is an asset. But stationery that have been used, it remains as an expense because you cannot attach a value to it because we have used it. There is no value to it. Therefore, we say 2,480, the total amount of stationery that was bought during the year, minus what? Stationery on hand, stationery that was not used, stationery that still has a value of 180. Then this stationery will also go where? To your current assets as stationery on hand or consumable stores on hand. Then 2480 minus 180, it gives us 2300, which is a stationery that we used during the year. Then let us look at bad debts. Adjustment number 2 in slide 3. A debtor, Mr. Mountain, has disappeared, and his account of 720 must be written off as irrecoverable. Then this particular debtor, we need to adjust the amount for debtors control simply because this debtor has failed to pay as per our agreement or as per our arrangement. Then for bad debt, we are going to say 4,000 rand as per your trial balance total plus 720 because we are experiencing an increase of bad debts. Then we'll have a total of 4,720, which is in relation to the total bad debt amount that we incurred during the financial year. Then we go to salaries account. Adjustment number 3. Salaries for February 2015 are still outstanding. That means an amount that we are going to find of 22,550 as from the trial balance is an amount of salaries that were paid for 11 months, of which we are owing 1 month installment or 1 month salaries. Then we say 22,550 divided by 11, you get 2,050, which is the amount of salaries that we pay monthly. Then we add salaries of 2,050 for February, then we get a total amount of 24,600. Then this 2,050 will also go to your statement of financial position as an accrued expense, a current liability, or an expense payables. Then wages, there are no adjustments, so we took them from the trial balance or pre-adjustment trial balance as they are. Insurance, number 4. We are having an adjustment there. Insurance includes an annual premium of 3,600 on a new policy which commenced on 1 November 2014. So we were paying as from 1 March until October, last day of October, before we started a new policy which started in 1 November. So it will be for 12 months, but starting as from 1 November. So this is how we are going to calculate this amount. We are going to say 4,500 rands taken from the statement, taken from the pre-adjustment trial balance minus this annual new policy of 3,600. Then we discovered that we just paid 900 rand if we exclude 3,600 from 4,500. Then 3,600 divided by 12 because we were told that this is an annual premium, so it's times 12. Then we get an amount of 300 rands. Then we multiply this amount by 4 because it is from November to February. November, December, January, February. Then we got 2,100, which is an amount for what? So if we say 300 rand times 4, you get what? You get 369 1,200. 1,200 plus the 900 rand that we have paid before a new policy commenced. Then you get your 2,100. Then let us look at a continuation of our expenditures or expenses. You have telephone account 7,900 taken from the pre-adjustment trial balance as it is. Your bank charges 2,210 taken from the pre-adjustment trial balance as it is. Then we have one account, depreciation, that we are only having an adjustment. Depreciation, whether it's depreciation on vehicles or depreciation on equipment, but we have one expense account called depreciation. Then depreciation must be provided as follows. So they are giving us an instructions with regard to how to calculate or how to account for your depreciation on equipment at 10% per annum according to the diminishing balance method. By diminishing balance method, they are also looking at a reducing balance method, a form of depreciation or a method that is calculated using what? A book value or a carrying value or a carrying amount. Carrying value or book value or carrying amount or carrying value is calculated by saying cost or historical cost minus your accumulated depreciation, then you get your book value. So this is how we calculated a depreciation on equipment, because it's clear that there is no new equipment that was bought or there was no disposal during that particular financial year. So we said 170,000 cost or historical cost minus 94,500, which is accumulated depreciation. Then we got a book value of 75,500 multiplied by 10% as per the instruction above. Then we got 7,550, which is our depreciation for equipment. Then let us now look at the second instruction with regards to vehicles and depreciation. On vehicles, at 20% per annum on cost price. So cost price, we are only applying rate to our historical cost. Accumulated depreciation or carrying value is not affected. So it's also called a cost price or a straight line, because the depreciation amounts, they are almost the same, because we expect that we use an asset or we consume the economic benefits or service potential in a manner that is equal or distributed evenly towards the useful life of these particular assets. Then for vehicles, we are also told that a new vehicle was bought for 95,000 rands on 1 September. So the historical cost of vehicles is inclusive of old vehicles and new vehicles. Why do I say that? It's because we are given balances as per 28 February, but also we are told that on 1 September we bought an asset. It means that this amount of 95,000 is part of this historical cost for vehicles. And the historical cost for vehicles as per the pre-adjustment trial balance is 190,000. 190,000 minus 95,000 minus a historical cost of the new asset, then you get 95,000 again. So the new asset is worth 95,000 times 20% times 6 over 12. Now, why do we say 6 over 12? It's simply because we bought an asset, or rather, let us go back to our timeline. We said the beginning of our financial year was 1 March 2014, and the end of our financial year was when? 28th February 2015. So from September, October, November, December, January, February. So it's 6 months. So we're going to multiply it by 6 over 12. Then we get 9,500 Rand, a depreciation for the new assets. Then that is the last figure on our calculations in brackets. Then we calculate the depreciation for an old asset. That one we say 95,000 Rand, its historical cost times 20% times 12 over 12 or times 1, because these assets we had them for the whole financial year, which is 1 year. Then we got an amount of 19,000. Then for depreciation, we said 7,550 for depreciation on equipment plus 2 depreciations from vehicles. The old assets depreciation was 19,000, and the new assets depreciation, new vehicles depreciation amounts to 9,500 Rand. Therefore, we got a total of 36,000 and 50 rands. Then we add all our expenses so that we get a total of 91,080 rands. Then we say 91,080 rands minus 406,228, which is our gross income. Then we get a net profit for the year of 315,140. And that's the end of our lesson. Please do not forget to subscribe, like, and comment. And make sure that you continue to visit our channel so that you can see, or so that you can learn from our lessons that will be uploaded soon. Thank you. Now, let us look at your notes to financial statement. If we are referring to notes to financial statement, we are referring to calculations. Now, we are preparing the financial statement in such a way that we are now categorizing similar entries, similar accounts, so that it is easy for us to do what? To prepare the statement of financial position or this balance sheet statement. So we will start with an account called stock, or a note called stock. This note comprises of your trading stock and your consumable stores on hand. Take into account that if we are referring to stock, we are referring to a current asset. Trading stock, we are referring to the closing balance or stock on hand, the stock that was bought during the year, and or rather but it was not sold. Therefore, it's the closing balance at the end of the financial year. It will be an opening balance when in the next financial year. So we are going to we're going to treat it as what? As an current asset, trading stock or inventory. It depends which term do you prefer to use. Trading stock is 56,000 rands. You will remember that this particular trading stock, or this amount, is the amount that we got after doing what? After preparing, or after conducting, to be more precise, conducting the stock count. The stock count gave us a value of stock that we currently have in our premises, which is valued at 56,000 rands. Then you have your consumable stores on hand. With the consumable stores on hand, we are looking at stationery that was not used. Remember, we said earlier that whenever we buy stationery during the financial year, we treat it as an expense. If we treat this stationery as an expense, then at the end of the financial year, this particular stationery, then we say stationery that was bought as from the beginning of the financial year until the end of the financial year. Since we have treated it as an expense, what we need to do now is that let us look at, do we still have stationery on hand unused? Because that particular stationery has a value attached to it. It can still have a value that is measurable, that is measured in a reliable manner, or that can give us a reliable figure or value simply because it's still to be used. Therefore, that stationery, we call it, or we group these things that we bought during the year but are on hand, we group them and call them consumable stores on hand. Remember, whenever we are preparing financial statement, there is this gap concept that we cannot run away from, which is materiality. So it will be immaterial for us to list these particular accounts or entries separate, where we say stationery, where we say maybe exam pads and pens, all those items individually, because we believe that in a total overview, these accounts or these entries are of a material nature. Not necessarily that we do not need these items, but they do not impact entirely when it comes to the decision making, when it comes to the strategic planning, or when it comes to users of financial statement interpreting the financial statement or trying to make sense out of this financial statement. So we regard them, or we regard these items as immaterial. Then we group them and call consumable stores on hand items that were bought, that we use or that we have used during the financial year. Then you get a total of 56,108 that will be separately disclosed in your balance sheet or statement of financial position. Then let us continue to the second note to financial statement. This particular note, we are looking at trade and other receivables. With trade, we are looking at a situation where we as a company or we as an institution are or entered in a transaction or normally enter into transactions of buying and selling. And other receivables, with receivables, we are referring to current assets, amount of money that we expect to receive. We are still expecting to receive even on the last day of the financial year. We are still expecting to receive even as from the next financial year, because these are receivables. By receivables, we are referring to a situation where we have earned this income but not yet received. So it belongs to us, but we are still going to receive. We are entitled to it or to this amount of money, but we do not have. We are still expecting to receive. Then let us look at your debtors control. Again, with your trade and other receivables, you are still looking at your current assets. Then with trade and other receivable, let us first look at trade debtors, because we have two types of debtors. We have trade debtors and we have other debtors, or rather say trade and other receivables. Then with debtors control, we take an amount straight from your pre-adjustment trial balance as it is, of which it will be the closing balance, but still to be adjusted using the adjustment at the end of the financial year. Then we say minus your bad debts bad debts that we were informed about in our adjustments. Then we say debtors control minus bad debt, because this balance of 34,000 rand was calculated before we were informed, or before we were made aware that we still have further debtors that we still need to take into account or adjust for. So you say 34,000 rand, which we got from the pre-adjustment trial balance, minus your 720 rands, of which we got from the adjustment where we were informed to write off further bad debts of 720. Then at the end of the financial year, the most reliable balance with regard to your debtors control is 33,280. That's your debtors control. Then we would say less provision for bad debt. Why do we say less provision for bad debt? With provision for bad debt, we have created a fund, or we have adjusted our fund, where we said we need to set money aside previously when we were creating this provision, but now we need to adjust it to 1,662. It means that these debtors, somehow we believe that they are not going to pay us. If these particular debtors, they are not going to pay us, we rather do what? We rather have a situation where we reduce the amount of money that we expect to do what? To receive. Not necessarily that the debtors controls are being reduced, or the trade and other receivables are being reduced, but the total receivable notes we need to reduce is when we say this particular bad debt, or this particular debtors are not going to pay us, or out of the total amount that we expect to receive, 1,662 we won't receive, or there are possibilities or high chances that we are not going to receive this particular amount of money. Then we say minus 1,662. Then we get 31,618. Then we add accrued income, or income receivable. So it means that during the financial year, there was an amount of money that we were expecting to receive, or that we have earned but not yet received. So we call it an accrued income that is still receivable. And if we go back, we look at the statement of financial position, your statement of income statement of comprehensive income, or income statement, where we're looking at other incomes. With your other incomes, we found out that as per the fixed deposit percentage, we were expecting to receive more than what we have received. So the amount in your statement of comprehensive income, we had to add 5,370, where we said the initial investment must multiply by 12% as per the pre-adjustment trial balance. Then we got 5,370, of which is our accrued income. Accrued income, or income receivables, of 5,370. Lastly, we will look at prepaid expense. Prepaid expense occurs when we pay more than what we are due to pay within the financial year, and we start paying for the next financial year while we are still in the current financial year. So those overpayment, we regard them as assets, because we have paid this particular amount of money. It is still entitled to us, because it is not yet due for payment. Then at the receiving end, they have received this particular amount of money, but not yet earned this amount of money. Therefore, it is not they are not entitled to it, but they will keep it up until these particular months that we're paying has passed. Then they will enjoy this amount of money as a revenue to them. But for now, to them, it is an opposite. It is a liability, which we refer to as an income received in advance to the receiving part. But to the paying part, we call it a prepaid expense because we have paid more than what we were expected to pay within the financial year. We have paid more than what was due, limited to the financial year. Then that particular amount was as a result of an insurance. So with an insurance, we paid for 12 months, but the months that were needed or the months that were due for this particular financial year is 4 months. Then for the rest of the months, which is 8 months, which is 300 times 8, it gives us an amount of 2,400 rand, which means our prepaid expense is 2,400 rand. We're going to record it under current assets because it's due to us, or we have paid more than what is required within this financial year. Therefore, we have paid it, but it's not yet due. Then at the receiving part, or at the receiving end, they have received it, but they are not entitled to it because they haven't earned it, or they are still to earn this particular amount of money. Then we get a total of 39,388 with regards to our trade and other receivables. Then lastly, let us look at the cash and cash equivalent and capital note to financial statement. Again, you need to understand that when it comes to the statement of financial position, we are categorizing entries, we are grouping accounts of similar nature. So the statement of financial position, basically it's a summary of your notes to financial statement and few adjustments as from your statement of comprehensive income or income statement. Then your cash and cash equivalents. So we are looking at the actual cash. With the actual cash, we are looking at petty cash. Petty cash, we are looking at cash, physical cash within or that is kept in on our premises. We keep this amount of money to buy what? To buy materials or to buy stuff of less value of amount of money or that are cheap, or where this transaction, or rather whenever we buy these items, the issue of signing a check is unjustified or there is no reason for that. So with those minor expenses, 10 rand, 20 rands, we keep an actual cash so that we are able to buy those products or those items that are needed within the particular business and that are daily needed for the company to be able to fulfill other parts of its operations. That is petty cash, which is cash. But now, once we start looking at equivalents of cash or cash equivalents, we are looking at accounts where we look at accounts of, it's not literally cash, but somehow it's similar to cash. How? Look at, or rather, let us compare petty cash and your bank account. Petty cash, we are looking at the actual cash, but the bank account, we are looking at cash that is not with us, that is kept by our bank or our financial institution. So bank becomes similar to cash, bank becomes an equivalent of cash, then petty cash become an actual cash or physical cash or literally cash. Now, other entries or other accounts that may fall in here with regards to your cash and cash equivalents are your investment, if your fixed deposit will mature within the financial year, it will be recorded under your equivalence of cash, or your short investment, your 3 months investment, they will be recorded as equivalence of cash, because it is not cash per se, but it's similar to cash, it's almost cash, it's equivalent or can be compared, or there are similarities to it with the actual cash. So for the purpose of this activity, or for this exercise, we are going to look at your bank account and petty cash. Only those two belongs to your cash and cash equivalents, or meets the criteria to be categorized under your cash and cash equivalents. Your bank account, firstly, we're going to take a balance as from the pre-adjustment trial balance, which is 40,900. It's a given amount. Then we add what? The bad debt recovered. Bad debt recovered, remember, it's an income account. Therefore, we're going to add it because our bank balance is not updated with regards to this amount of money. Therefore, we will need to increase it so that our bank account reflects the true balance, reflects the true financial activities of this particular institution within the financial year. So we're going to say 40,900 plus 280, which will give us 41,180. Then petty cash as it is, because there is no adjustment in relation to it. If at the end of the financial year, petty cash amount was increased from 500 to 1,000 rand, we were going to add this 500 so that we are having a new balance of 1,000 rands. But unfortunately, we have no entry to make other than to take this amount as it is and record it to this note to financial statement. Then you add these two, then you get a total of 41,680. That will be your cash and cash equivalents current assets. Then let us look at your capital, or rather, lastly, let us look at your capital account. Your capital account, we are referring to the amount of money that was contributed by the owner of the business at the beginning, but also again during the financial year. This particular owner is at liberty to do what? To add or to make additions toward his capital contribution. So this particular owner is allowed to make additions during the financial year. But again, this owner is allowed, even though the owner is discouraged to do what? To do withdrawals. Withdrawals in the form of cash, withdrawals in the form of stock or inventory that we regard as drawings. Then what you need to do here, balance as on 1 March. So you are referring to an opening balance, which we are going to take from the pre-adjustment trial balance, which is 899,760, plus your net profit for the year ended, which is 315,148, which we got, or which we took from the statement of comprehensive income or income statement. If we made a loss, we were going to say less net loss for the year ended, then the amount was going to be presented in brackets to symbolize a loss, to symbolize a decrease, or to symbolize that in this financial year we made a loss. Then we add these two, we get an amount of 1,214,908. Then less drawings. Remember, we are calculating the drawings from the beginning of the financial year until the end of the financial year. Then, this particular owner cannot use or is not entitled fully to this amount of 1,214,980. We need to take into account the fact that this particular owner also made withdrawals during the financial year. Then, whatever that he is going to get or she is going to get, it should be 1.2 million 1,214,908 minus 73,360, which will give us 1,141,548, an amount distributable or an amount that this particular owner is entitled to. Thank you for watching. On our next lessons, we are going to complete other notes to financial statements and prepare the statement of financial position or a balance sheet. So it will be a continuation of this particular lesson. Stay tuned. Don't forget to subscribe, view my videos, like and comment. Thank you.